I hope everybody's well. This is the last lecture for Module 7, which is going to be our last module, which covers GILTI, FEDII, and BEAT. Now we're going to discuss BEAT. I want to start by going through the Steptoe and Johnson PowerPoints addressing BEAT, which is section 59, Cap A. So let me share the screen. Hope everybody sees that. So again, we're talking about base erosion, anti-abuse tax, section 59, capital A. It was enacted in December 2017 as part of the Tax Cuts and Jobs Act. Let's go to the next slide. So in that bullet in the bottom, it says that the base erosion minimum tax BEAT is generally designed to ensure that a U.S. corporation pays at least 10%, 5% in 2018, 12.5% beginning in 2026 on its taxable income, adding back certain base erosion tax benefits. By the way, that percentage is greater with respect to banks and registered security dealers. So the normal rate is 10%. It becomes 11% for banks and security dealers, 6% in 2018, 13.5% beginning in 2026, again, unless this is modified by subsequent legislation. Hasn't been on the day I'm recording this, January 3rd, 2022. B can apply to both U.S. and foreign-owned groups of related corporations. Let's go to the next slide. By the way, I think it begins in the Steptoe and Johnson, which I should be posted in the class's website. The BEAT, I think, begins on page 55 in that write-up. So BEAT equals the BEAT tax rate times modified taxable income, and you subtract from that a regular tax adjusted to eliminate the effect of certain credits. We'll see that the research credit will benefit taxpayers with respect to the BEAT calculations, but not so the foreign tax credit. The second line is BEAT tax rate equals 5% in 2018, 10% after 2018 through 2025, 12.5% in 2026 and years thereafter. Modified taxable income equals taxable income without regard to base erosion tax benefits. And base erosion tax benefits, by the way, encompass, payments to a foreign-related party, like interest expense or royalties, but it also encompasses things like depreciation on assets purchased from a foreign-related party, beginning in years when BEAT became effective. So it wouldn't encompass assets bought from a foreign-related party before BEAT was effective, so before 2018. Modified taxable income equals taxable income without regard to base erosion tax benefits. Fourth line, certain credits, including foreign tax credits, other than allowable research credits, and 80% of general business credits, including low-income housing credit. After January 1st, 2026, there is no adjustment to regular tax for the effect of any credits, meaning credits claimed reduce regular tax and therefore increase BEAT. So let's look at the first bullet. The BEAT applies to corporations other than regulated investment companies, called RICs, real estate investment trust, also referred to as REITs or S corporations. And again, you have to have average annual gross receipts for the 3 preceding years of at least $500 million. So if you were a relatively, small corporation, you would not be an applicable taxpayer, and therefore you would not be subject to BEAT. The tax does not apply, however, unless, I'm looking at the second bullet, unless the foreign related party deductible payments made by a corporation are 3% or more of the corporation's total deductible payments, modified for any payments to surrogate foreign corporations and certain reinsurance premiums. A surrogate foreign corporation is a corporation that has undergone an inversion, so we'll see there are more adverse rules with respect to payments made to an inverted company. If the inverted company is treated under the applicable code section as domestic corporation, this does not apply. It applies to situations where under the code, the corporation, the inverted company, is a foreign company, but subject to a 10-year limitation on using certain attributes. Well, we'll see, and I'll mention this now, that normally payments for cost of goods sold are not covered by the BEAT provisions. They are not considered bad payments. But if the company is an inverted company, not treated as domestic under the inversion provisions, then what takes place is payments for cost of goods sold is considered to be a bad payment. So we got to watch that. Look at the third bullet. There's an aggregation rule that applies these thresholds to all entities that would be treated as a single employer under Section 52A. Last bullet, the BEAT contains several special rules for banks and registered securities dealers, subject to a 1 percentage point higher rate, 6% for 2018, 11% for 2019 through 2025, and 13.5% thereafter. The 3% threshold for foreign related party deductible payments is reduced to 2%. We'll come back to that. Exception from definition of base erosion payments for qualified derivative payments for taxpayers that annually recognize ordinary gain or loss in such instruments. Derivative defined for the first time in the code, previously defined and similar definitions contained in Representative Dave Camp's Tax Reform Act of 2014 and Senator Wyden's Modernization of Derivatives Tax Act of 2017. Let's go to the next slide. Modified taxable income for purposes of the BEAT computation is taxable income without regard to base erosion tax benefits. These are these bad either payments or deductions, either payments to a foreign related party or deductions or amortization with respect to assets bought from a foreign related party. Base erosion tax benefits include, I'm looking at the second bullet, deductible payments to a related foreign person, like royalties, like interest, amortization and depreciation with respect to property acquired from a related foreign person. Again, that only applies to acquisitions from a foreign related person, once the BEAT provision is effective. So it wouldn't apply, for example, to a 2016 purchase of an asset from a foreign related party. The third sub-bullet under bullet 2 is certain reinsurance premiums or other consideration paid to a related foreign party. Payment, and the fourth bullet, payments to a surrogate foreign corporation under 7874 that reduce gross receipts. Let's look at the third bullet. Related party includes any 25% owner of the taxpayer by vote or value of any person related to the taxpayer, any 25% owner of the taxpayer within the meaning of sections 267B or 7701B1 and any other person related to taxpayer within the meaning of section 482 under common control. So it's a relatively low threshold to be a related party, not a more than 50%, but 25%. Let's go to the fourth bullet. Note that payments for cost of goods sold are reductions in gross receipts, not deductible payments, and therefore do not increase B liability, except, however, for payments of cost of goods sold made to a surrogate foreign corporation. That is a foreign, an inverted company that continues to be treated as a foreign corporation under section 7874. Let's look at the fifth bullet. There is an exception from base erosion tax benefits for payments to related foreign persons for services if such payments, one, would qualify for the cost method under section 42 without regard to the requirement that the services not contribute significantly to fundamental risk of business success or failure, and two, do not contain a markup. And under that, based on a colloquy between Senators Portman and Hatch, there is some question about whether it is possible to bifurcate payments between cost and markup. And the regulations answer that in a taxpayer-friendly manner. So really only the markup is going to be impacted. And the last bullet, note that if the base erosion tax benefit that is disregarded, not the payment itself. Accordingly, where a taxpayer makes a base erosion payment to a subsidiary that is a controlled foreign corporation, which results in subpart F inclusion of taxpayer, the deduction for the payment is disregarded, but the subpart F income is not, i.e. modified taxable income is increased by the subpart F income from the payment, but is not reduced by any deduction for the payment itself. And that continues to be true. The regulations did, however, provide that if the base erosion payment generated ECI, effectively connected income, then it would not be considered to be a bad payment. It would not be added back in calculating BEAT. That's a taxpayer favorable result, but it does not change the result for subpart F. So the U.S. taxpayer is taxed on subpart F income, but payments to a foreign related party that give rise to subpart F income is still added back in terms of the BEAT calculation, which is a bad result, an anti-taxpayer result. Let's do this. I think it's 60. Regular tax liability adjusted for certain credits. Regular tax liability means a taxpayer's regular tax liability under section 26B used for applying limitation on amounts of credits claimed. I'm sorry, my wife will pick this up. Okay. Regular tax liability is then adjusted by eliminating the effect of, i.e. adding back certain credits. Under the BEAT formula, a lower regular tax liability results in a higher BEAT because regular tax liability is subtracted from the product of 10% times modified taxable income. In the absence of any adjustment, the effect of credits, a taxpayer with a modest amount of base erosion tax benefits could owe BEAT that is more attributable to the effect of claiming credits, i.e. reducing regular tax and therefore increasing BEAT. The adjustment to eliminate the effect of certain credits is intended to protect the value of such credits from the BEAT for a period of time. The adjustment only applies to the research credit and 80% of the general business credits. there is no adjustment for foreign tax credits. So this is a bad result. So to the extent you get foreign tax credits that reduce regular liability, your BEAT will go up. Last bullet, the adjustment only applies until January 1st, 2026. After that, there is no adjustment to eliminate the effect of any credits. Any credits claimed could result in additional BEAT. Let's go through this BEAT example that Steptoe and Johnson gives. They use very small dollars, but remember, BEAT only applies if during the 3 years prior to the year in question, the average gross receipts, exceed $500 million. Or at least $500 million. So just, so if this were in fact the true numbers, there wouldn't be any BEAT to begin with. But let's go through this example anyway, realizing that you've got to add a number of zeros for this to really be meaningful or to apply. So in this example, gross income equals $500, and that includes 150 of subpart F. There are deductible payments to third parties of 100. Deductible payments to a related CFC is 200, 150 of which is subpart F income. We'll see that $200 of deductible payments to related CFC is going to be added back in terms of the BEAT calculations. Amortization with respect to intangible property acquired from a foreign related party, that's added back too. That's also producing a base erosion benefit that also gets added back. Research and development credits were $10 in this example, and foreign tax credits were 15. So, BEAT is equal to, let's look at this formula, 10% times modified taxable income. Again, modified taxable income, you've added back, these base erosion tax benefits, less the regular tax liability adjusted for certain credits. So the U.S. corporation's taxable income here is equal to 190. So we start with the 500 of gross income. We subtract $100 of payments to third parties, $200 of payments to related parties, and $10 of amortization with respect to intangible property acquired from a foreign related party. By the way, that latter category, again, we're assuming, the example assumes that the intangible was acquired after BEAT became effective. Okay, so the pre-credit tax liability is 39.9. It's the $190 of taxable income times the 21% corporate tax rate. The U.S. corporation, putting aside BEAT, would pay 14.9 after taking into account $25 of total credits. That's the $10 of research and development credits and the $15 of foreign tax credits. BEAT's going to apply here because there were $210 of base erosion payments. 200 of that were deductible payments to related CFC, and 10 was amortization with respect to intangible property acquired from a foreign related party. That exceeds this 3% threshold of total deductions. Therefore, BEAT applies. Modified, I'm looking now at the fifth bullet, modified taxable income equals 400. That's the 190 of regular taxable income plus the 210 of base erosion benefits. That is the 200 of deductible payments to a related CFC and the $10 of amortization with respect to intangible property acquired from a foreign related party. So So you multiply that 400 times the beat rate. Now, in effect, this assumes that the taxpayer is not a registered securities dealer or bank. You take 10% times 400, and modified taxable income is 40. And what you do to compute beat is you take this 40 of modified taxable income. You subtract from that the 39.9 pre-credit US tax liability, but only the foreign tax credits do you no good. The research credits do you a good. You're really adding that 10 back. So the US shareholder would have 14.9 regular tax liability plus the 15.1 beat. So the total US taxes would be 30. The point here is that beat is an addition to one's regular tax liability. This transaction occurred, in 2019. There would be no credit that's counted at all once 2026, once we go to 2026 under the statute. But here the beat is lessened because of the $10 of research and development credits. This is added back, increasing one's regular liability for this purpose, therefore decreasing the beat liability. Again, if something I'm saying is not clear, you can always email me. And the last line was, note that subpart F income is included in calculating modified taxable income. So this is something where many of you might say it seems unfair. You're picking up subpart F income on these payments to the foreign related party, assuming the foreign related party is a CFC. Only CFCs would generate subpart F income. But at the same time, you're picking up the income, but you're adding back the payment to the CFC and figuring out your modified taxable income. And with that, I think I'm going to stop sharing. Okay. So BEAT, by the way, is an acronym for Base Erosion and Anti-Abuse Tax. The actual title of Section 59, capital A, Cap A, which is where BEAT is located in the Internal Revenue Code, is tax on base erosion payments of taxpayers with substantial gross receipts. BEAT is covered in your book in paragraph 66, Cap A. Only going to touch upon a little bit of that. I'd urge you to read 66 Cap A on your own, as well, frankly, as reading 59, the section itself, 59 Cap A. Let's turn to your book. I'm in 66 Cap A.1. So Professor Loken writes, Congress in 2017 added a new minimum tax that may apply if a large company is a result of its base erosion payments to foreign-related parties, realizes base erosion tax benefits. Very generally, a base erosion benefit is a payment to a related foreign party that is deductible for U.S. tax purposes, and such deduction is a base erosion tax benefit. For example, if a U.S. company has borrowed money from a foreign related party, interest on the loan is a base erosion payment to the extent it is allowed as a deduction, and the deduction is a base erosion tax benefit. An amount paid or accrued in purchasing depreciable property from a foreign related party is also a base erosion payment, but in this case, it is a deduction for depreciation of the property, not the price paid for the property, that is the base erosion tax benefit. A foreign related party is a foreign person that is, one, a 25% owner of the taxpayer, Two, related to taxpayer or 25% owner of the taxpayer within the meaning of 267B or 707B1 partnership provision. Or three, a controlled taxpayer together with or with respect to the taxpayer for purposes of Section 482. Let's go to the next paragraph in 66A.1. Let me stop for a drink. The tax applies to any corporation, domestic or foreign, for each taxable year or which it satisfies two conditions. So two conditions. One, average annual gross receipts for the 3-year period ending with the taxable year preceding the current year are at least 500 million gross receipts, which is called the gross receipts test. And two, its base erosion percentage for the tax year as at least 3% base, which is called the base erosion percentage test. By the way, that goes down to 2% in the case of banks and security dealers. For many major companies, 3% is a relatively low threshold. So, assuming you hit that $500 million gross receipts test, most companies, most multinational companies, would be subject to BEAT. He goes on to say the base erosion percentage is very generally the ratio of the taxpayer's base erosion tax benefits for the taxable year to all deductions allowable for the year. The tax thus applies to a company exceeding the $500 million threshold if base erosion tax benefits makes up more than 3% of its deductions. The tax is very generally the excess of 10% of taxable income. Again, that's the regular percentage 2019 through 2025, computed without deductions for base erosion payments over two taxpayers' regular tax liability for the year. Again, the BEAT is in addition to one's regular tax liability. Let's go to the third paragraph in 66 Cap A.1. The base erosion percentage and the tax depend on the corporation's base erosion payments and base erosion tax benefits. Very generally, a base erosion payment is a deductible payment made to a foreign related party, and the deduction for such payment is a base erosion tax benefit. Congressional concern about base erosion payments was stimulated by inversion transactions in which a foreign corporation is inserted as the parent of a multinational group formerly headed by a domestic corporation. Inversion transactions have often been accompanied or followed by transactions undertaken for the purpose of reducing the taxable income of U.S. members of the multinational group. Let's go to that next paragraph, which is paragraph 5 in 66 Cap A.1. Very importantly, however, the BEAT is not limited to companies affected by inversion transactions. The tax can apply to any U.S. company or any foreign company with a trade or business in the United States. Assume a foreign corporation licenses a patent or copyright to a U.S. subsidiary, and the subsidiary pays periodic royalties to its parent. The subsidiary is allowed deductions for the royalty payments, and the parent is a resident of a country with which the United States has an income tax treaty. The parent may not be subject to tax on its royalty income. The royalty erodes the U.S. tax base, and the BEAT may apply. The Internal Revenue Code and the regulations provides specially for several types of payments and transactions. Why don't you read the rest of that on your own? So read 1 through 7 on your own. The next paragraph says, arguably, Section 59 Cap A is inconsistent with non-discrimination articles in income tax conventions. If it is, the statutory rules may override the treaties. Both of these issues are, however, unresolved. They continue to be unresolved. As far as I know, it's not been, well, it hasn't been successfully challenged. Generally, a corporation must file Form 8991F, tax on base erosion payments of taxpayers with substantial gross receipts for a taxable year if it has gross receipts of at least 500 million for the taxable year, or either the two preceding taxable years. The requirement does not, however, apply to corporations to which the BEAT cannot apply, and that again would exclude RICs, regulated investment companies, real estate investment trusts, REITs, and S corporations. Look, I'm not going to cover everything in terms of BEAT. I'm just trying to give you a foundation, basic understanding of the BEAT provisions. In his BEAT analysis article, Jack Cummings, I'm sorry. So Jack Cummings, the author I mentioned before to you, he wrote a BEAT article, an article about BEAT in the tax notes issue of March 26, 2018, titled Selective Analysis, the BEAT. He pointed out that Congress intended for the BEAT to have two roles: to be an anti-base erosion provision in the cross-border context and a sort of minimum tax replacement for the repealed corporate AMT that punishes paying foreigners without regard to traditional notions of the base erosion. This alternative, corporate alternative minimum tax, the regular one, was repealed by the Tax Cuts and Jobs Act. But in a way, BEAT is a new type of corporate minimum tax. Mr. Cummings notes that the best way to avoid BEAT is not to be an applicable taxpayer, a term used in Section 59 Cap A and defined in 59 Cap A little e in parenthetical. I'm not going to go through that. But again, if you have gross receipts in 3 prior years of under $500 million, you're not going to be impacted. If you're an S corporation, a REIT, a RIC, you're not going to be impacted by the BEAT provisions. Or you don't meet that 3% threshold. 2% in the case of banks and registered security dealers, you won't be subject to BEAT, although that will not exclude many U.S. companies. Trying to look at my highlights. So Cummings in his article points out that the 3% base erosion percentage, or 2% in the case of banks and security dealers. What's happening here, the numerator is the bad deductions that produce base erosion tax benefits. The denominator starts with them and adds all other allowable deductions. The denominator, however, does not include net operating losses. The new Section 245A deduction we talked about earlier, in earlier class, for dividends received from CFCs. It does not include the Section 250 FEDII or GILTI deductions. There are a few other deductions excluded from the denominator. That leaves the denominator all the major historic business deductions, compensation, such as compensation and benefits, depreciation, amortization, interest, taxes, and rents. So Cummings points out something that we've studied already, but the BEAT is a 10% tax rate, again, 5% in 2018, 12.5% 2026 forward. Applied taxpayers' modified taxable income, which is normal taxable income without regard to base erosion tax benefits of the base erosion payments and to the base erosion percentage of any NOL deductions allowed for the year. The taxpayer's deductions deducts its modified regular liability from B and pays the difference. Just want to see if things I want to highlight quickly. Bear with me. Yeah, something that I mentioned before, but Cummings reiterates that it's important. He points that Section 59A had to use two terms, benefit and payment, rather than one payment, because the base erosion tax benefit might result from the current payment yielding deductions like interest and royalties to a foreign related party. Or it could encompass depreciation and amortization of property purchased from a foreign related party, assuming the purchase occurs when BEAT is effective. You know, these deductions, things like interest and royalties and service payments, most service payments, the term encompasses really all ordinary necessary business expenses. So in general, with inverted companies, where the company remains foreign, not treated as domestic, cost of goods sold payment is not considered to be a base erosion payment, not a bad payment. But if the company is a foreign related, is an inverted company and is treated as foreign, then you would have to add back cost of goods sold. By the way, the House version of the Build Back Better Act would have expanded BEAT to encompass cost of goods sold, for all taxpayers. But we'll see what happens, if anything, to that. Cummings points out, again, we covered this earlier, but I'm just reiterating it, the compensation paid for services is the largest corporate deduction. Applicable taxpayers commonly pay foreign related parties for services, even though those payments are central to concerns that produce the BEAT. Congress took a large chunk of service payments off the table, payments without a markup over cost for some services. And again, the regulations were even more taxpayer favorable in this regard. It really just, excludes the markup. The last point I want to cover with respect to BEAT, and I do want to point out that I did prepare a PowerPoint for Module 7, including materials on BEAT. So please take a look at that in addition to reading 66 Cap A of the Loken book and reading Section 59 Cap A. If what takes place is the taxpayer on an outbound payment is subject to full 30% withholding tax, under 881, then that is not considered to be a base erosion payment. Is that clear? So if there's been a full 30% withholding tax, not reduced by a treaty, say a payment to a Brazilian company, there's no ratified treaty with Brazil, And therefore the payment is subject to a full 30% withholding tax. It's not considered to be a bad payment. It's not a base erosion payment that'll be added back in terms of the BEATS calculation. Under many treaties, what takes place is it's not all or nothing. It's not 30% or zero, but there is a reduction by virtue of the treaty of some of the 30%, say to 15%, to 10%, or 5%. In that case, there is some partial relief in terms of treating the payment as a base erosion payment. For example, if the withholding rate is reduced from 30% to 5% under the treaty, then 5/6 of the deduction will be a base erosion payment. I hope that's clear. I think I'm going to stop here. If you do have any questions about BEAT or anything else, please feel free to contact me. Everybody have a very good evening, and you take care. Bye.